Here we go again. Everyone's favorite time of the year is on the horizon. Income tax time. If your client is planning to buy a home this quarter, which I highly recommend, listen up because income taxes can influence the mortgage process. I don't know about you, but I like it when home loans close smoothly, and that's what we're all about here at the Mark Townsend team. There are a few things that you should know to prepare for this time of year. First, let's start with W-2 wage earners. These borrowers do not own 25% or more of a company. This is important because sometimes self-employed people, those with 25% or more ownership, pay themselves a W-2. They like to think of themselves as wage earners, but the reality is, from a lending perspective, they are classified as a self-employed borrower. This means self-employed guidelines are going to take precedence. Now, if your client is a straight W-2 earner, it's easy peasy. This time of year, the lender isn't going to be that worried about the tax filing. They're going to be looking at the 21 and 22 W-2s and will be looking for stable income. If the income does not appear stable or is declining, that is a red flag. The 22 W-2s would have been issued by the end of January, and lenders are going to be asking for those. Getting this documentation up front is really a key for any lender to set the borrower and you up for success. Second, what about self-employed borrowers? That's people like real estate agents and anybody who owns 25% or more of a business. This could be a sole proprietor, a partnership, or a corporation. It can also be someone that is on contract with a company and paid a 1099. All of these buyers are going to fall under the self-employed lending guideline requirements. What do self-employed people need to know about tax filing timing and extensions? The lender is going to need the two most recent filed tax returns, currently 20 and 21, as well as a profit and loss, or P&L, statement and balance sheet for 22 and year-to-date 23. This documentation will be required until the borrower has filed their 22 tax return. At that point, the 21 and 22 tax returns are used together with the year-to-date P&L for 23. Now, why is that? Lending guidelines require the underwriter to determine the income is stable. The underwriter uses the P&L to verify the income since the most recent tax return has remained consistent or risen. With self-employed borrowers, there is always more documentation because there are a lot of moving parts. Now, many self-employed people will submit a tax filing extension instead of their tax return on April 15th. This is not necessarily an issue, but the lender isn't going to use 22 income for qualifying until the 22 tax return is filed. If the buyer's income in 22 was much higher than 21, they'll want to get that 22 return filed as soon as possible. When you ask a self-employed person for their annual income, their answer often will be higher than the taxable amount on their tax return. This is primarily due to the many deductions allowed by the tax code. However, the income lenders use for qualifying is often very close to the taxable income on the return. This is why it's so important to have your borrowers talk with an experienced lender that understands the details that go into structuring home loans for self-employed borrowers. Timing is everything. If you have clients you want us to talk through this process, we're happy to do a quick 15-minute consultation with them. Just have them click on our schedule link in the description below. Working together, we can deliver an informed and seamless buying process for our self-employed buyers.